Welcome to The Explainer, where we break down big ideas using the source material itself. Today, we're diving into an investment strategy that pretty much flips conventional wisdom right on its head. It's called systematic trend following.
Let's just kick things off with this bombshell of an idea. We've all had the mantra buy and hold drilled into our heads, right? It sounds so simple, so wise. But what if it's not really a strategy, but more of a marketing slogan? A way to make sure firms get their fees whether you're making money or losing it. This one question, really, is our doorway into a totally different way of thinking about the markets.
So to really get why an alternative is so powerful, we first have to put the classic buy and hold approach under the microscope. You know, on paper it sounds great, disciplined, long-term. But its biggest weakness, its Achilles heel, really shows up when the market takes a nosedive, which, as we're about to see, is pretty much guaranteed to happen.
This quote from the legendary investor Peter Lynch, wow, it just hits the nail on the head. It perfectly captures the psychological trap of buy and hold during a crash. Your head knows the plan. Your head says, hold on, don't sell. But your stomach is in knots as you watch your portfolio get crushed, down 20, 30, maybe even 50%. And that feeling, that raw fear, that's what takes over and makes people sell at the worst possible time, right at the bottom.
Our source materials paint this really vivid picture of the market. It's not some rational machine that steadily climbs upward. No, it's more like a giant emotional pendulum. It almost never sits in the middle at fair value. Instead, it's always swinging to one extreme or the other, from wild overpriced euphoria to rock bottom, underpriced depression. And here's the key takeaway. Those deep, painful crashes aren't a bug in the system, they're a feature. A buy and hold strategy forces you to ride that pendulum all the way down into that dark place.
Okay. So if buy and hold means strapping ourselves to that violent pendulum, what's the alternative? Well, it's a strategy that doesn't try to fight those swings. Instead, the goal is to ride the momentum. And the core idea is actually borrowed straight from a basic law of physics.
This is it. This is the whole idea behind trend following. Just like a bowling ball rolling down the lane, a stock or a market that's moving in one direction has a pretty good chance of continuing in that direction. The goal isn't to be a psychic and predict when a trend will start or end. The goal is to simply identify a trend that's already in motion and then ride it for as long as it lasts.
So what does a trend actually look like? It's a bit more specific than just the price is going up. As you can see here, the technical definition is this really clear pattern. The peaks, or the swing highs, keep getting higher, and the valleys, the swing lows, also keep climbing higher. It creates this beautiful little staircase pattern going up. That's the visual proof that the buyers are in charge. And of course, a downtrend is just the opposite, a staircase heading down.
All right, let's get into the first and maybe the most important tool in the Trend Followers Toolkit. How in the world do you cut through all the daily noise, all the headlines and the chaos to see the market's real long-term direction? Turns out the answer can be as simple as one single, elegant line on a chart.
Now, the 200 days simple moving average sounds super technical and complicated, but it's really not. All it is the average closing price over the last 200 trading days. That's it. You just add them up, divide by 200, and you do that every day to create this smooth, flowing line. Why 200 days? Because that's roughly a year of trading. It acts like a giant filter, smoothing out all the short-term bumps and wiggles to show you the big picture trend.
And this is where the system's beauty really shines through. It's so simple. You can boil it down to 4 steps. You plot the line. You ask one question, is today's price above or below it? If it's above, the long-term trend is up. That's your green light. If it's below, the trend is down, and your main job is to play defense and protect your money. It's not about feelings or forecasts. It's a binary yes or no rule.
And our source material puts it just that bluntly. For a lot of systematic traders, this isn't just a suggestion. It is a non-negotiable ironclad rule. If a stock is trading below this key line, it's a massive red flag. The market itself is telling you that, over the long haul, the sellers are in control and something is wrong.
But here's the thing, identifying the trend, that's only half the battle. The other half, and you could argue it's the more critical half, is all about managing your risk. And this is where the pros really separate themselves from the amateurs, because it all comes down to how you decide how much to bet.
So let me just ask you this. When you think about a trade, do you risk, say, a flat $500 every single time? Or do you think about the unique personality of each stock? A professional trader knows that risking the same amount on some sleepy utility stock as you would on a wild, high-flying tech stock, well, that just doesn't make any sense.
This slide just lays it out so clearly. On the left, that's fixed sizing. You're treating everything the same, which ignores reality. But on the right, that's volatility-based sizing. This is the pro move. You adapt. You might take a smaller position in a really choppy stock so that its normal daily swings don't give you a heart attack. You're sizing your bet based on the stock's actual behavior.
So how do we actually measure a stock's personality? The go-to tool for this is the average true range, or ATR. All it does is tell you in dollar terms how much a stock tends to move on an average day. Is this a 50-cent a day stock or a $5 a day stock? The ATR gives you one clean number that quantifies that normal, everyday choppiness.
Okay, and here is the rule of thumb for how you actually use that number. When you set your stop loss, that's your get-me-out point if the trade goes south, you don't just pick a random number. You place it at a distance of 1.5 times the ATR below where you got in. So if the ATR is $2, your stop loss is $3 away. Why? Because you're placing your exit outside of the stock's normal daily noise, giving the trade room to breathe so you don't get shaken out by random meaningless jiggles.
So we have our entry rule, the 200-day average. We have our risk rule, the ATR stop loss. I mean, this sounds like a perfect mechanical system, right? But now we have to talk about the single hardest part of trend following, the thing that causes most people to throw in the towel, the psychological torture.
This is the whipsaw. Just imagine this. The market's in a great uptrend. Everything's looking good. Then suddenly, it dips just below your 200-day line. Your rule says you have to sell. You take a small, frustrating loss. And then, the very next day, the market rips right back up and continues a massive rally without you. That feeling of being shaken out for a small loss right before a huge move, it is just brutal.
And that right there is the brutal truth. A trend-following system is designed to have lots of small, annoying losses and a few gigantic winners. Those big wins are what pay for everything else and then some. But what it feels like is loss after loss after loss from these whipsaws. It feels like the system is broken. And this is the exact moment when you are at your most frustrated that most people quit the strategy, often right before the next huge, account-changing trend finally takes off.
So if it's so psychologically painful, why in the world would anybody do it? Well, this brings us to the final and most crucial point. It's about letting go of trying to be right on every single trade. It's about having a system that just has a positive edge over the long run.
What a great way to put it. A trend follower isn't some guru with a crystal ball. They're more like a meteorologist. They're not saying, I guarantee it will rain tomorrow. They're saying, hey, the conditions look about 70% favorable for rain. The goal is simply to build a system where over hundreds of trades, the odds are stacked in your favor. You're going to be wrong a lot, but your wins will be so much bigger than your losses.
And this chart, this shows you the ultimate payoff. Just look at this hypothetical performance during a nasty bear market. The buy and hold account on the left is down big. It was forced to ride the market all the way down. But the trend following account on the right is actually up. How is that possible? Because the system's rules would have signaled an exit early on as the prices fell below that 200-day line. By getting out of the way, by protecting capital, the trend follower is in such a stronger position when the next bull market finally starts. That's the power of this strategy.
So we end on this simple question. Are you building a system, or are you trying to predict the future? You know, so many of us start our investing journey by trying to guess what's going to happen next. But what our sources suggest is that real long-term success comes from a shift from prediction to process. It's about building a set of rules, a system, and then just having the discipline to follow it day in and day out. The question this all leaves us with is, which path are you on?